Greetings again, guys. This is Ali Hussein Kasim of Ali Talks Tech. Today is our fourth episode of Ali Talks Tech of the second season. I'm privileged today to have with me Kamau Kunyiha. Kamau is not just a business partner, but he's part of our men's club, where we do karaoke together every so often. Kamau is a special person. He is smack in the middle of the data conversation in financial services. But let me not spoil it for him. Let him introduce himself, what he does, where he's come from, how he has been able to become one of the most important personalities when it comes to fintech in the region and financial services. Boss, karibu sana.
Thank you, Ali. Great to be here. I'm honored and privileged that you invited me to be
you're welcome.
Part of this. And I'm sure it's going to be an engaging discussion. Now, about myself, you asked so many questions, I don't even know where to begin.
Just begin from the beginning.
You hype me up, I don't, I was even wondering if you're talking to the same person.
I am. Sometimes it takes somebody to look from outside to appreciate who you are. So
I appreciate that.
Please take the privilege.
Okay, so I don't know where to begin. As Ali mentioned, Kamau Kunyiha. I'm the regional manager at Creditinfo for East and Southern Africa.
How many countries are those, Kamau?
With actual credit bureaus now, we're only looking at 4, where we actually have operating bureaus.
Okay.
But we have other markets where we do partner with local businesses, or we are providing technology to central banks.
Presence in how many countries?
In Southern Africa, we're looking at we've got obviously Kenya, Uganda, Tanzania. We have presence in Sudan, South Sudan as well. Sudan and South Sudan, where we provide the central bank with technology.
Okay.
We partner with local business in Angola.
Wow.
We also in Zimbabwe, we provide central bank with technology services.
Okay.
And in Namibia, where we have an actual bureau operation.
Interesting.
Yes.
Interesting. So how did you come to be in the credit reference bureau business? And I think as you talk about that, because I think the organization that you lead has sort of evolved from not just credit reference bureau, CRBs, to something else. Maybe you want to talk to us about that and the need for those services in our region.
So not exactly the institution that I'm currently with, but where I was before.
Correct.
And that's where my journey started. And it started before credit bureaus were actually in existence in Kenya.
Okay.
And in a lot of Africa, actually. Maybe just, if you look at East and Southern Africa, it was probably just South Africa at the time that actually had bureaus in operation.
Okay.
At the time we started. So it was a local company started by Kenyans, based on a need at the time where they found there was a lot of issues in actually trying to get payments. And, this is just business-to-business payments. And one of the founders, the main founder, started this business on the back of a business he had, sending out invoices and not getting payments. So he started off by actually publishing a list of people who had not paid him.
Wow.
And circulate that list, basically. As rudimentary as that is how it started.
And circulating that list.
That
could be a problem with data privacy today. But
so
it was a different era.
That was basically, call it CRB 1.0.
Yes.
At the time, where in the late 1990s, as it started. And over time it evolved, he actually pushed it through. So as you can imagine, it started off as a debt collection need.
Interesting.
That is actually what brought it around in the market here. The business evolved. Here, the founder was able to bring this up with the central bank, and at the time, it was also opportune because this is a time when we started seeing a lot of the commercial banks in Kenya actually collapsing because of what they termed at the time of migrating debtors, where I borrow from one bank and go to the other, and no one was able to track
bad
them.
debts.
Yeah, and you remember your continental banks.
Correct.
And there were quite a number of banks that actually collapsed in that period of time. And so it was, I guess, for the founder, the conversation with the central bank at the time was very opportune and something that was needed. So they started, although it would have needed an act of parliament, which was going to take some time. So the governor, I might not have this in exact order, but
Yes.
he did give permission for banks on a voluntary basis to share their data.
Interesting.
So banks started sharing this data on a voluntary basis. But for the founder, this needed to make some business sense.
Yes.
So how do you get some money out of it? So converted the business to a debt collection company.
I see.
So set up a collection.
That then was the component that was making money.
Yes. So I would set up a collection shop where you're calling up debtors that owe money to the banks and you're collecting for them. That information of unpaid loans is what would be converted into credit information.
Wow.
So you had defaulted. It has been outsourced to a debt collection company. They're collecting on it, and you probably even have a payment plan. And that information is being converted into credit information for banks to be able to use to assess. But also remember, at the time, retail debt was still unknown in the market. It was still it was non-existent, actually.
Completely.
It was actually a lot of collateralized lending and everything.
It was mostly business.
Yes. But, and now we're looking, this is the early 2000s that we're looking at. So then, if you remember this very well, the first bank that actually started going into proper retail loans was Barclays at the time.
Yes.
And they started offering salary loans.
Salary loans, yes.
I remember they even used to pitch tents.
So that's Barclays before it became ABSA.
Yeah. And started offering these salary loans, which was actually opportune for the business that I was in at the time, because the debt collection component became very key in their process. Yeah. So if you're going to open up lending, you need to make sure your entire process is well covered for. So the collection business actually grew. And we actually, the business grew from just Kenya, but grew out into 8 other African countries.
This company?
This company. It was called Credit Reference Bureau Africa Limited, or CRB Africa.
Interesting.
The business later on, and the founder and his partners later on, this is just fast tracking it.
Yes.
Pushing this agenda. 2010 is when we finally got the Act of Parliament. The law was printed that credit bureaus will be in place, and banks were mandated to share at the time.
It became a legal mandate.
Yes, but only to share negative data. So if you took a loan and you've not paid, that was the only thing that would be shared. So that was the first thing that was passed, negative data sharing in 2010.
2010.
Yeah.
So that's about 13 years ago.
Yes. I believe, but the act, I think, is an act of 2008, but actually enacted in 2010.
Yes.
Around about then.
I mean, it takes time for these government things to come to life.
We had the negative data sharing that started at the time. And so it meant every single bank needed to start reporting this information. Now, this was also
reporting into
the license bureaus.
So at this time, basically, after enactment, you only had one, CRB.
The first licensed bureau was CRB Africa, yes.
CRB Africa.
Yeah, that was the first licensed credit bureau. Then Metropole followed a year later, and they got their license. So CRB Africa and Metropole were pretty much the two were there from
the beginning.
From the beginning, pre the legal status.
In fact, you could say that CRB Africa literally created this market in Kenya.
And in quite a number of the other African markets that we went to. It actually stemmed from...
That was one innovative guy.
Yes, very innovative, yes. He still is. So
that was your beginning.
That was my beginning in this industry, space. In this financial services space, as it was at the time.
As it was at that time.
It was more financial services that we were dealing with. Then, as this negative information was being reported into the bureaus, the idea of having this information shared is that it would allow banks to open up lending to more people without having to ask for collateralized loans, which are expensive, and it would make it more easy to actually lend to more people. But so in other
words, risk-based lending, but really, at least in theory.
In theory, although you've gone a few steps too far. Okay. At first, it's just to be able to know, do I know who you are?
Yes.
Can I understand? I just need some other collateral on you to know that you are worth the amount I'm giving you. Or
some level of confidence.
Some level of confidence. So, but the problem was the only information that was there was negative data. So the bank said, they went back to the central, and the central bank is pushing for this lending to open up. But the bank said, look, but we really don't know these guys because all we know are the bad guys. And they didn't want to share the information on the good guys because there was a bit of hesitation that, there could be poaching of good customers between the banks because they would be able to see each other's good customers. I mean, these were the issues at the time. This is something pretty new in the market.
I'll come to you later and talk about this new concept of who owns a customer.
Yeah.
But let's please.
We'll get there.
Yes.
So we got into now saying, okay, we need to have positive information shared in the market. So that process started, and it kicked in the regulations were changed in 2014 for negative information, positive information to be shared alongside with the negative information. Now, if my memory serves me right, at the time when we only had negative data being shared, we probably had about records on about 700,000 individuals.
In a country of?
At the time, 40 plus.
40 million people.
40 plus million.
What does that tell us?
We only had 700,000. Either the banks don't lend enough or we're good payers. So anyway, there's still very little data that could...
To make any decisions.
To make any decisions, or that was really viable or anything of substance to say. It's only about 700,000 records. So the positive data sharing started in 2014.
Okay.
2014 is when now the organization that I'm with now, Creditinfo, thought
Creditinfo.
It's now an opportune time to go into that market.
So that's 2014.
2014,
okay.
Once the regulations were being set out, they said, okay, maybe it's an opportune time to look at this market.
Okay.
But the license didn't actually come in until around 2016.
What was the license for now?
All the bureaus are regulated by the central bank.
Correct.
So you need to apply for a license from the central bank.
So the license was now to be able to share both positive?
No, this was Creditinfo applying to come into the market.
I see. Okay.
Yeah.
Mm-hmm.
But so it was still a bit late. So from 2010 to Creditinfo was coming into the market around about 2016 is when it actually came to market. Getting to full operations around 2017.
Okay.
Around about then. But, some operation in 2016.
Okay.
So the industry has been about 7 years. The Metropole and TransUnion have been there from about 2010 and 2011, around about there. So positive data started coming into the market. Now this started seeing a big change. So data volumes increased tremendously because now we've got quite a number of facilities being reported into the bureau.
So how did you get the banks to start accepting that we can share positive data? Or was this an instruction from the central bank?
No, I think it was not. I think it was known that it was the banks knew positive data sharing was going to be beneficial. I think it was
but
more
they were
around.
Hesitant.
It was more around how is it going to be implemented? How do we secure ourselves as banks to ensure that our data or our customers cannot be poached. I mean, it's just the mechanism around it that needed to be defined for the banks to feel comfortable. I don't think the banks didn't know the benefits of positive data sharing. They're very aware of it.
But they were scared of losing their customers.
They just needed to make sure that the process around it is actually well laid out and defined. So I think that is the main thing that was necessary.
So what changed?
So there was a lot of workshops that were done and stakeholder engagements on how and addressing all the different issues that were there, if any, on how to actually implement and drive forward the positive data information sharing regime that came through. So it flowed very quickly and very easily because the bank started seeing actually the benefit of actually opening up to the market and lending to more people. And then you've also got to remember, this also kind of coincided with the Kibaki government when they came in and they reduced government borrowing. And the banks had to go to the market to lend.
To lend so that they can fill the gap left by revenues from treasury
and you remember
bills.
there was a big wave of
I remember.
Retail lending that
I remember, and Kenyans were like, wow.
Yeah. So they, from that time, the benefit of opening of lending to the masses had been seen, and the banks were making good profits. So the sharing of positive data was not too much of a struggle, should I say.
So at what point did the digital lenders and fintechs swarm into the market?
Yeah,
and how important was the CRB ecosystem for them and to date in terms of consolidating all this data from non-banking institutions to straight into the financial services ecosystem?
Yeah. So, and I guess, this is something that people always argue about and discuss. The fintechs came and opened up a market that was not known and everything, which is true. They did, but also, I also tend to side with the bank sometimes. They know it's there, but they just have to. Their processes are very different as a regulated sector.
But Steve, my response to that.
Yes,
my response to that is simply this: banks in financial services, as some of our friends would like to call them, incumbents, have a very strong legacy in financial services.
Mm-hmm.
They have extremely strong lobbying power. I mean, for crying out loud, the former First family owned the bank. So what stopped them from doing what the fintechs came to do, including M-Pesa?
I think you need, just to remind you, in the market today, when it comes to digital lending, the biggest digital lenders in this market today are commercial banks.
100%.
So they're not far removed. They're in there and they're playing, and they're major players.
100%. I looked at your data, your Creditinfo data a couple of years back.
Our benchmark report, yes.
Your benchmark report, and that was 93%.
Yes.
So even as we are making a lot of noise about bad players in digital lending, 93% of all digital lending was still being done by
commercial
banks.
But the fintechs came and brought something that was new, or showed the banks how to do something new. And I think the biggest question, a banker would best be placed to answer this, is the KYC process on digital that was of concern to the banks.
And that's where the telco came in.
Yes. So the telco becomes very critical. And again, for the banks, unfortunately, even today, if I'm to go to my bank to apply for any facility or anything that I want, despite being with them for 10, 15 years, I have to reapply like a new customer.
But this is what I don't understand.
So this is what the fintechs came to. That's the difference, a major difference that they came to fill in, and were able to pick something that the banks were leaving out.
So, look, you are you're at the sort of cusp of this data sharing in financial services. And for me, I look at this, if I look at this holistically, even that 93% we've just talked about, without you know who, the banks will not be able to lend that money.
That's very true.
Without M-Pesa, let me just name it. Without M-Pesa and the data that comes from M-Pesa, they will not be able to do it. So the question to me is, have they let the proverbial monster into their boardrooms? Or is this a partnership that you feel that will continuously improve and grow? Because at the center of this huge growth in personal lending is data from a telco, not data from a banking institution.
Yeah. Ali, and this is, again, I need to, across the different commercial banks, and it goes back to the point you raised earlier that we would speak about whose customers are they and everything. I think the reality of the matter today is that efficiency is what the customer is looking for. The most efficient process
100%.
is what they will go for. These processes, and I don't know, banks consider, I don't think they were well prepared to think about, or their mindset was not for the retail. It was to do banking as they do banking.
Yes.
Whereas the telco setup, their mind was for retail and they were consumer centric.
So it was a good meeting of two partners who had different strengths.
However, that said, I think one side of the party let go of the ball and let the other run with it.
So we are now in 2023. Come on. And over the last couple of years, we have had a lot of complaints about bad players in digital lending. And it has now, it forced the regulator, the Central Bank of Kenya, to basically come in and say, no, wait a minute. We must regulate this space. As long as you're lending money on a digital platform, you must come to us and get a license. We are into the first innings of this new dispensation. The first DCPs, as they are called today, digital credit providers, were licensed a couple of months ago. I don't think it's even a year that has passed. How is that changing the landscape?
Okay, I think this is actually also very important. From a consumer protection perspective, it was key because digital lenders were just a registered business, and anyone can go to the register of companies, register a business, and lend their own money.
Some will call them very unsympathetically,
because
digital loan sharks.
Yeah, because I've got a couple of million, I can get an app and lend to very many people.
Yes.
And which is fine. You can do what you want with your money.
Your money.
It's business and everything. But also I think there's a responsibility within government or within certain sectors in government to safeguard the citizens. Now, it's a willing seller, willing buyer situation. But then also we've got to be able to have certain guidelines in how business is operated. We can't just let people run like the Wild West. And
let me just come out and say it. There are some extremely bad players in that space. I have been a victim of it.
They just needed to be curtailed and something needed to happen.
But it's still happening. Yeah?
It is. And
so I'm wondering what is going on. It's still happening.
Ali, even today, regardless of depending on whatever, all these regulations you have, there are still some bad apples in different highly regulated areas.
That's true.
You will never be able to clean it 100%.
I mean,
but then at least there's recourse if that person is found and can say, you are being charged for this and this and this. But before, what is the charge?
I recall in December 2022, I was on holiday with my family down at the coast where I come from. And I get a call from a number I don't know. And I'm told, hey, my name is so-and-so from this so-and-so company. This person has given your name as a guarantor. So here's the thing. We are giving you two options. This is how she's talking to me. Number one, pay this guy's loan. She's not even telling me who this person is. Pay this guy's loan. Or call him and tell him to pay his loan. Or we are going to harass you until this is done. So I'm like, so I was taken a bit aback. I'm like, what do you mean? Who is this person first who's given you my name as a guarantor? No, we can't tell you his name. I'm like, so now how am I supposed to? So finally they gave me the guy's name. I have no clue who that person is. I said, look, I can't help you because I don't know. But this person says he works for one of the companies you are involved in. So how can you say you don't know him? I said, which company? So she gave me the name of that company. I called the CEO. And she calls this guy. Says, why did you give the Ali's name? I said, no, I didn't. So it turns out they scrapped information
from the phone.
From the phone, number one, but also from the website of the company. And found my name as one of the directors, went on to LinkedIn, got my details, and called me. So I'm like, okay, fine. I mean, look, I can call the guy and tell you, I said, guy, she was extremely obnoxious.
Yeah.
Do you know, she promised to call me every 10 minutes until I sort out the problem for them. And that's exactly what she did all day. Every 10 minutes.
That's a very good collector. Doing the wrong thing, but a very good collector.
So what I did is I said, Leom Taniona. I took all the screenshots of the missed calls and numbers on my phone for the day. Kamau, there were 50 phone calls. 50.
Wow.
From different numbers from the same company. And I posted them on social media. And I posted the name of the company. And then I tagged the commissioner of data protection. Why? But not everybody knows what to do like me.
Yeah.
So we have people's data out there. Yesterday, I was speaking to someone who is a doctorate in cybersecurity. And he told me shocking stuff. He said, Ali, there's all of you Africans' data are somewhere on the internet. Because you leave data on a banking platform, you leave data on one of the government websites, and all your data is being scrapped by other people, including passwords. What do we do, Kamau? We want progress. We want data sharing. Yeah. And we are pushing for more, open banking, manenos and stuff like that. But how are we protecting people's data? We continuously hear this it's become old now and a cliche. Data is the new oil. Nobody's asking.
How do you protect it?
One, how do you protect that oil? Two, who has the license to dig for that oil? And are you digging it responsibly?
Yeah. Ali, I keep saying, the issue of data protection didn't just arise now with digitalization or ICT. I don't know. I'm sure you would remember very well back in the day in Kenya, in the butcheries. How did they used to wrap meat?
Magazeti.
And sometimes even statements.
Well, even today, because, sometimes I find myself not having paper in the house, so I buy a newspaper.
Yeah. Yeah.
To get wrapping paper, not to read the newspaper.
To get wrapping paper.
Yes.
But do you remember the what they call dot matrix printed documents?
Absolutely.
And you'd get stuff wrapped with that as well.
Yes.
And you'd actually have people's data.
Data there. Yes, absolutely. You're absolutely right.
So this is not something new. It's just that the quantum at which it happens today
is because of technology. Because of digital technologies. It's that 100x more.
Exactly. But it has always been there. Today, we have a problem of almost every single building you're going into. You're being forced to put down your ID number, your name, and your mobile phone. I mean,
so that thing, apparently it's a law.
Apparently, yes.
You know that it's a law. It's a security law. So I ask myself, if I put a wrong ID number and a wrong phone number, am I liable by law?
Good question.
And this is a question I'd like to ask my sister, the commissioner of...
You'll have her here at your next session.
Yes, I will. I will have... Because you are left wondering, that information they're asking for is what I call social engineering hackers paradise. You have my ID, you have my phone number, you have where I come from, which company I come from. Those three are the basis to find a way to get into my bank accounts or my M-Pesa account, to hack into almost anything in your organization. I mean,
it's a basis of a SIM swap. I've got your
name. It is actually the basis of a SIM swap.
ID and a mobile number.
So I'm asking myself, these clowns, without due respect, who passed this law, if at all it is a law, what were they smoking that morning?
But, you know, I won't get into that. But as we're talking about data and to tell you where we came from with the Bureau and the sharing of data,
yes,
the story was building up. So we moved from negative to positive data sharing.
Correct.
From 700,000 individuals on the Bureau at the time,
yes,
to today over 18 million individuals on the Bureau.
Wow, that is like what?
Over 35% coverage of the population. Now,
more than 10 times growth.
Yeah, and a lot of times we get people coming in that are saying the Bureau does not have good coverage of population. I can assure you. Yeah, let me tell you, in any Ali, borrowing in this nation, in this country, happens in urban or peri-urban areas where you've got some sort of economic activity that is happening.
Correct.
Anyone else in the rural area is not borrowing.
Is not borrowing.
They don't need. There's no economic activity that is actually driving them to borrow.
Everyone is fulizing these days, even
but but you know, in those areas, maybe it's there, but very little, because you're fulizing to pay what? You're self-sufficient.
That's true.
Most of them are self-sufficient.
That's true.
They're growing their own food.
That's true.
And everything. There's really hardly any need for that. So when you look at 18 million, and that 35% is against,
you have cover
a 50% population, 50 million people plus. That's the entire population, not including the children and the old people. So if you to look at the adults, you're even say from 18 to 65, we are covering a very good percentage of the population.
So if you look at the regions you cover, how do we compare in terms of financial services data?
So when you look at it from that perspective, Uganda, Tanzania are both between 7 and 10% bureau coverage.
Wow.
Namibia is a lot higher. Namibia is probably about 65%, but they're only 3 million, 3 million people.
But we know historically Namibia is really an extension of South Africa.
South Africa, yeah. But your general bureau coverage in the other markets is around about 7-10%.
Okay.
And you're right. What has made it grow is the digital lending. And we've got to give credit where it's due. Had it not been for M-Pesa in this market, access to finance would not be to the levels that it is today.
No, I think hats off. M-Pesa takes a lot of flack.
Yeah.
Many times. But that is the nature of also human beings. They go after the most renowned brand. But look, not just the lending, the whole backbone of the fintech ecosystem has grown because of M-Pesa.
Absolutely.
I mean, let's give credit where it's due.
And it goes back to, yes, we had the banks and everything, then the fintechs came in. The fintechs would not have survived or not even have come in if they didn't have that backbone of M-Pesa.
100%.
That actually drove it and is what sustains that industry today. So it has been a big driver in enabling it. But that said, it should not be a stumbler for innovation, because I believe there's still a lot of space within that payment space that is still not being explored or has not been tapped into. There's potential to do a lot more.
So basically,
and this is where we get to your question about owning a customer.
Yeah, who owns the customer?
Because everyone is bringing in a piece, but no one is owning everything.
So let me ask you a question that has been on my mind before we started this conversation, and something that you and I have discussed before. How many Kenyans have digital loans or mobile loans?
Well,
on average,
this 18 million that I'm telling you that's on the bureau, majority of them is data that is derived from a digitally
acquired loan. Okay.
So I think what you want to ask is, on average, how many loans does an individual have?
I was going to come to that, my next question. So on average,
so
if you have 18 million people with digital loans, on average, how many loans does one individual have?
The last data I looked at, I think it's probably about on average, it's probably about 3 to 4 loans per person. Around
3
about
to 4 loans per person.
On average, but that is something, it's been a while since I looked at that data. But we have seen individuals going to as high as 7 loans per individual.
What?
We've seen to that level.
7 loans per individual.
Yeah. And I think
those are a bit outliers, for sure.
Yeah, those are the outliers. But in general, overall performance in the country, because you'd think that there are that many that the performance is bad. Overall performance is actually not that bad.
On average, what are the NPLs?
About 15.
That's non-performing loans.
About 15% of the data that is held on the bureau are those of people who are not paying.
15%.
So, yes, the 85% are people who are paying as per contract and paying on a regular basis.
That is interesting.
So generally, people are paying very well. When you do find many people taking a lot of these multiple loans, and this we can derive from the data, because you can see loans coming in and going out. It's more of a function of lenders not wanting to take too much risk on an individual.
Okay.
So I will lend to you, but Ali, I'm only willing to take a risk of up to 10,000 shillings.
Okay.
But I can see that Ali probably has a capacity to take 80,000, 90,000.
But I'm just giving him 10.
My risk
because he's overstretched.
No, I'm only willing to risk up to 10,000. You know, the digital loan market is very interesting because it's high velocity lending. So it's
every
money
month
coming in. It could be every day.
What?
It's money coming in and out every day, because, you know, people will borrow and repay multiple times within a month or even in a week.
Wow.
So it's not that every loan that is taken will be paid in 30 days.
So basically, when a digital lender says we have lent 20,000 loans, it could actually be, out of those 20,000 loans, a good percentage of those have actually borrowed multiple times.
Absolutely. Repeat customers.
Let me tell you, that data is so interesting.
It's I mean, it's huge. And you can imagine, so it's about understanding your customers' affordability and about customer retention. But these things are all open there. I can see that Ali has borrowed 6-7 times with this month, and each time he's taking 10,000.
To be clear, 10, I don't do that.
No. So, a lender could actually identify those customers and say, actually, for these customers,
that's interesting.
We'll give you a credit line of 80,000 because we've seen this is what your consumption is anyway.
Wow.
And then you use it almost like a credit card or a line of credit.
Steve, we are coming to an end of our super interesting conversation. I want to give you an opportunity to talk about Creditinfo, if you'd like.
Yeah, sure. Yeah.
And tell us what's different. Where do you see this financial services data going forward in relation to what Creditinfo is doing?
So, like I mentioned, there were these two bureaus in market that were there. We came much later on, and by the time we were coming in, a lot of the lenders, the banks, and everything had partnered with the bureau that they want of choice, and were working with them. And now coming into the market that late and going to these customers and telling them, hey, the question, what are you doing different? What are you giving us? So
yes,
we were really forced to think about our processes very different. So a credit bureau is all about data.
Yes.
That's the underlying thing that,
what that's data the core.
Have. That's the core. So that always remains something very core to us. And we're always looking for additional data to add to that. Then we brought in another layer. You like using the word layering. So brought in analytics. So the analytics is actually just about how do you get insights out of this data to be able to make the right decisions. Now, this is working in partnership with or drawing good insights about these customers based on that data. So you have your scores. And then over and above that, building scores is one thing. But then what does that score mean?
Yeah.
So what we call, we just don't call it analytics, but we call it decision analytics.
Decisioning, okay. Mm-hmm.
So you actually have the data, and you're actually getting decisions. So one of the things one of the mantras or taglines we use is that we help customers identify their most profitable customers. So we're not about a black and white list.
Okay.
Yes or no, but it's about which customer is more profitable.
So to put it in a nutshell, you can tell bank XYZ, this guy has 4 loans on a monthly basis, but we see that he's a good pair. So, and we also see that his income is this amount. So please feel free to.
So you can give a rate.
Yes.
So we exist in risk-based pricing. We'll be able to help with the term for how long should you give this facility for those facilities that are not digital 30-day loans. And we'll also be able to give a limit. What level should you actually lend to this person?
So has any one of your customers come to you and say, okay, this guy has 4-5 loans. How can we convince him or her to consolidate all these loans through us?
No. So that we don't do. But it's definitely something that could be looked into doing
I think so.
If a bank is looking to say, this is my customer, how do I own this customer? Let me, it's more of a
interesting
bank
business
decision
models there
for them to do that. But so with every single client that we engage in, it's not just about the data.
Yes.
It's about the decision analytics that we deliver. Now, over and above that decision analytics, the other thing we layer on is the technology. How is this delivered within the customer's environment? So we plug in our decision engines with our clients so that we have a full spectrum of the service. So drawing the data from its raw base to actually actionable outcome that they can insights that they can put forward in their business.
Kamau, thank you so much. This has been a fascinating conversation. Yes. I'm sure we'll continue to have it. Ladies and gentlemen, that was Kamau Kunyiha, Regional Managing Director, Eastern and Southern Africa for Creditinfo, one of the leading credit reference bureaus in the region. Asanteni sana for taking the time to listen to myself and Kamau. And we look forward to the next session. Kwaherini.